Okay, so the purpose of this video is to provide an update on Future Generation Global, or FGG. Future Generation Global and Future Generation Australia are both key positions in many client portfolios. As some of you will have realised, the price of FGG has been somewhat disappointing over the last 12 months or so. So what I would like to do in this video is firstly just provide a very brief overview of why we like FGG from a long-term perspective. And then secondly, I will address the recent underperformance and finally why I believe that that recent underperformance will be a temporary issue. So just to begin with, let me share my screen. So this chart shows all of the underlying managers that Future Generation Global invests in. So Future Generation Global invests in a portfolio of high quality global fund managers. Some of these managers you will have heard of, names like Magellan are very well known, Cooper Investors also, Antipodes. But there are also some managers in here that are very boutique and very hard to get exposure to, names like Caledonia Investors, VGI Partners, etc. What we like about the structure of FGG is that they get to invest in all of these managers for free. The managers waive all management fees, they waive all performance fees, and those fees can, in some cases, be well in excess of 3% per annum. So that is a huge saving that investors within FGG manage to achieve. In addition to that, if somebody was to invest in Caledonia Investments, the minimum investment amount is $1 million. So a lot of these managers are out of reach for the average investor. So in my opinion, FGG gives investors a really unique way to get exposure to some of the best managers that are available in a very simple and easy to access structure. The only other thing I'd like to point out is that within FGG, about 30% of the managers have what's called an absolute bias. In simple terms, that means that they'll be shorting stocks and they won't be as influenced, the performance of their portfolio will not be as influenced by the movements in the overall market. And so in simple terms, I would expect that Future Generation Global should be able to do better than the underlying global share market in a weak market, in a flat market, in a rising market, in all markets other than a really strong bull market. And last year was a really strong bull market, and FGG's portfolio was struggling to keep up with the underlying market over that period. But in recent times, with the volatility around COVID-19 and the like, the underlying portfolio has really started to improve, and you'll see that in this slide here. So this slide shows the performance of FGG since inception in 2015. You can see since inception, the underlying portfolio has generated a return of about 8.8% per annum, which is actually exactly in line with the global share market. So it's done an okay job. But what you'll see in the last 6 months, the global share market has fallen by about 2.5%. But FGG's portfolio is actually up 2.7%. Over the last 12 months, 1 year, FGG is up 5.8% versus the global share market of 2.7%. So essentially what has happened in the last 6 months or so with the recent volatility, that the portfolio of FGG has really started to deliver excess returns. And we believe that that should be a feature going forward in this sort of higher volatility regime. So that is the underlying portfolio performance. However, FGG is a listed investment company, and that means that the share price of FGG can trade at a premium or a discount to the underlying net assets. So in the short term, the price of FGG can deviate from what the underlying portfolio is actually doing. And in simple terms, what has happened over the last 12 months is that the underlying portfolio of FGG has gone up while the share price of FGG has gone down. So this chart here shows the performance of FGG over the last 12 months. So 12 months ago, FGG traded at about $1.38 a share, and today it's $1.14. So the price of FGG has actually fallen by 17% over 12 months, but the underlying portfolio has actually gone up by almost 6%. If we look at this next chart, this shows this light blue line is the share price of FGG, and you can see it falling away over the last 12 months from roughly $1.40 down to $1.14. And the dark blue line is the underlying net assets of FGG, and you can see that rising over the last 12 months. The shaded area shows whether the price is trading at a premium or a discount to net assets. So you can see in its early days, FGG actually traded at a premium to net assets, and it's also traded at times at up to a 10% discount to net assets. What you can see over the last 12 months is that the price of FGG has continued to trade at a bigger and bigger discount to net assets. So the discount is almost about a 25% discount to net assets today. Now, many investors ask why this is the case. Why does the price deviate so much from net assets? There's lots of different things that will influence that. There's recent price performance, whether the company has raised new money. They're sort of the main factors. And I think in particular with FGG, last year, it was struggling to keep up with a roaring bull market. So that was one factor that was influencing the price of FGG. In addition to that, the company raised money in late 2018, and a lot of new investors that came in under that capital raising have subsequently sold out. So that has put additional pressure on the price of FGG. But those factors, I think, are now behind it. And now that the underlying portfolio is actually starting to outperform the global share market, I think that it's only a matter of time before investors go back to realizing the underlying quality characteristics of FGG, given the ability to access these high quality fund managers for no underlying fee. And I think ultimately that will resolve the price trading at such a substantial discount to net assets. And so just to give an example, if over the next 12 months, if the global share market just went sideways, and if the underlying portfolio of FGG also just went sideways, but the price of FGG went from trading at a 25% discount to something more like a 5% discount in line with its long-term average, then that would result in a 20% return for investors. So for these reasons, we believe that FGG represents outstanding value at these.